Hey Rajat, hey Pat, you guys doing good?
Good.
Doing well.
Yep. Zaisha and Alex gonna join.
Hi.
Aisha, Rajat here.
Yes.
How are you?
Good, Rajat.
We cannot see you for some reason.
Start the camera. Do you really want to see? Okay. It's been a long day. It's been a tiring day. My child graduated from kindergarten. I'm in the office, so long day.
Yeah, I can hear you. We are missing Alex, I guess.
Should we start?
I imagine you want Alex. Am I wrong?
Okay, I think he will join us in a couple of minutes. I think we should start. Okay, so I believe we should start. Thank you. So, first of all, it's Mohammed Imtaz there. I'm working as a deputy manager in audit department of Akram Associates and PLLC. So, as you know, that today's topic is the navigating digital assets and its key takeaways for audit and tax professionals, right? So, as
हो सकेगा उसका बनवाइएगा फलाना जो फलाना आदमी मिलेगा उसकी पोस्टिंग का ये है कि सामान ये बात ही मुझसे करिए बराबर सर कौन को
yeah. So, as you know, guys, that it's the blockchain and cryptocurrency is an evolving industry, and we have no any formalized regulation or any law as of now for that. But we know that it is in demand and it's getting evolved day by day, and we are seeing many changes in this niche. So, as you know, that digital assets are no longer fringe finance. They are not central to institutional portfolios, family offices, and private funds. And over, I believe, 60% of institutional investors are either holding or planning to invest in the digital assets by 2026. And as audit professionals, and we must adapt rapidly to stay relevant in this fast evolving landscape, right? So, a brief introduction to blockchain and cryptocurrency audits. I believe, so let's start with blockchain. As you know, what is the first question that arises that comes into our mind with the blockchain? Guys, can you hear me?
Yeah.
Okay.
Yep.
Yep.
Okay. So I was saying about the blockchain that what comes in our mind with a blockchain is that it's a distributed ledger technology enabling secure, transparent, and immutable records. And transactions are validated via consensus. For example, as a proof of work, as a proof of stake, and it's a blockchain could be of two types. It could be public or it could be private chains, right? So let's start with the with uh, with uh, with this synchronous. Just a minute. Okay. So you know that this program is of basic level, right? So we don't need any prerequisites or any advanced preparation. And right now, I believe there are four entities that are sponsoring this. First is the Ikram Associates, second is Monarch, third is Auto, and the fourth one is NAV Consulting. I believe Rajat Jain is from NAV Consulting. I'm from Ikram Associates. Pat is from Auto, and Aisha is from Monarch. Right, guys? If you would like to give your brief introduction to all the viewers.
Yeah, thanks. I can go first.
Yeah,
Thanks, Hamza, for
sure.
introduction. I'm at SVP position here at NAV Fund Admin. NAV founded in 1991, so we always had been in a traditional space, but got in digital space about 8 years ago. So I serve multiple roles as a business development, thought leadership, and also client relationship to our clients. By qualification, I'm chartered accountant and CFA. It's good to be connected on this group. Over to you, Pat.
Hey everyone, my name is Pat Clancy. I head up growth over at Auto, which is powered by MG Stover. MG Stover has been in crypto for over 10 years now. And really what we have focused on of late is after selling off our fund admin services business to Securitize, we focus now strictly on the portfolio reconciliation tool called Auto. That tool works with fund managers, fund admins, number of different crypto platforms. We just launched this in the last month, and it's been a very positive conversation for us. But thank you for having, and looking forward to the conversation. Aisha.
Sure. So I am at Monarch Asset Management. I'm the CEO of the fund. We're a multi-strat um, hedge fund. We've been around in the space for like 9 years at this point, seven, um, with track record. I also teach the same subject at NYU.
So as we know that digital assets have moved from fringe assets to mainstream finance, and 86% of institutional investors are holding or plan to invest in digital assets by 2025, right? So I believe whatever domain we have, being an auditor, being a fund admin, being an investment manager, or in any capacity, we need to take care of this industry, right? We have to understand and evolve with this industry. And as we can see with the data and in front of us, we need to support our clients with the updated knowledge and with all the relevant knowledge and experience. And this is and as this is a very evolving industry, so we have to be very proactive, and we have to continually update our knowledge within this industry. So yes, so if we talk about its investment trends and institutional adoption, we can see is that what we have seen in the past few months is that the EY, I believe, they conducted a research, and they found out that around 60% of the institutional investors, they plan to allocate 5% of their AUM towards digital assets, right? And the reason is that first I would like to describe what's the reason that they are holding this they are holding why they are holding not to invest in this industry. The reason was lack of transparency and lack of uh, uh, a regulation on that. But as we have seen, I believe yesterday, the Genius Act was passed in Senate, and since the President Trump has came back in White House, he ensured that he's going to formalize and formalize the economy and going to start with digital asset space. So what we see in the investment trend is that there will be a lot of investment managers who are going to uh, place some or a significant portion towards the digital assets, and that's how it can rise to a seeable portion of their portfolio. And there are other motivations. I believe top motivations include the potential is their higher returns, their investment in innovation, and we might can say that hedging against inflation as well. And also, if we see the categories that family offices and other institutional investors, they are trying to switch their portfolio towards this towards this niche as well. And if we talk about its their regulatory landscape and tax implications, well, I believe from this year we will see 1099 separately for digital assets. Right now we don't have this, but I believe IRS is working on that, and might be by this year we will see the separate 1099 DA for digital assets. Right now, if we talk about their regulatory compliance and regulatory concerns, they are still unclear at the moment. But we have seen in the past 1 year, AACP has taken initiative and they have come up with a guideline for the valuation and for the reporting of digital assets. Uh, if we see the timeline that how these things get evolved from regulation point of view, it starts with conferences, feedbacks, and other activities, so that a public at large can learn from these type of industries, right? And then after that they come up with a formal law, and then we can have a a uniform gap standard, just like in insurance contracts. I believe they started with a separate insurance contracts, and after that and after the feedback conferences and getting the knowledge and over insights from the professionals, they implemented a gap. They came up with a gap and made a part of us us gaps. So what we see in the near future is that we might see a us gap on it as well. AACP has given a guideline back in June 24, which is helpful in valuing and reporting the digital assets. But right now I believe we lack this thing at the moment. But recently they have passed a Genius Act for stable coins. We will discuss this in a later part of this of this webinar.
Hello, Hamza. Can you hear me?
Yes, I can hear you.
Hey, everyone. This is Alex Cummings. I'm the moderator.
Sure.
I apologize for coming in late. I've had some technical difficulties over here. So if I could just pause and rewind just a quick second. I'm the tax partner here at Akram. I've been in the industry 27 years, worked on all things sort of fund related, and I appreciate everybody joining the panel and all the guests. I'd like to just apologize for not being able to get audio earlier. So thank you, Hamza, for sort of filling in. So if I could, I'd like to start actually moderating the panel. So Hamza, thank you for your thoughts on the regulatory landscape. I could just take a minute and see if there are any thoughts from the rest of the panel from their perspective, or any concerns that you might have that you'd like to bring up at this time.
I think maybe
I can,
just starting from the top. I know we had introduced ourselves. I'm glad you joined. I think really what would be interesting, and I know we had talked about some of these things, was specifically around the institutional adoption. And I think, Rajat had some really interesting comments before we had started this conversation. It really came around like the structuring of where products are going, what we're seeing with managers, et cetera. I could give you a few perspectives just on that. there's been a lot of just interesting trends that have been happening within crypto. I would specifically say, with Aisha on the call, like the structure of these funds is really starting to differ. What we've seen in particular has really opened into more hybrid type of fund structures. It could be an open-end fund with side pocket components, closed-end fund with liquid components. But what we're starting to see quite a bit of is these closed-end fund structures that have locked up capital, and they're participating in a lot more liquid activity. And so I think really the strategies evolve from, the type of structure these fund managers have, whether they're investing in privates, trading and investing, trading, on liquid portfolios, participating within DeFi. I think the thing that's happening in particular, though, is like there's these topics specifically around stablecoin that has come up, which Hamza brought up from a regulatory standpoint. But I also think there's another narrative around the tokenization pieces that Rajat was bringing up earlier. And so, as we think of institutional adoption, it really does come down to the technology and the ability for managers to be able to access these things. I think tokenization is on its way. I think there's nuances around the operational components to that. It's great that everything is on chain and accessible. But I think from a back office perspective, there's a lot of things that I'm sure Rajat thinks about from an operational standpoint, how to handle, tokenization, et cetera. But I think these things, and I want to just open it up in particular around the institutional adoption component. I really do think that, with the introduction of AI and some of these things that are automating, we're going to just continue to see more and more managers become more nimble, rely a little bit more on their service providers. And I think you got a healthy mix of us today. So maybe I'll pass the mic on that. I don't know, Rajat, Aisha, if you have thoughts on that.
Yeah, I mean, I can echo a lot of your comments here. So the institutional adoption of digital assets definitely happening. We are doing a lot of like working with the traditional manager over the year and then converting into digital assets. We see a lot of institutional investor coming into the space and asking questions. And after ETFs launch in Bitcoin and beyond now, beyond Bitcoin also there's the ETFs. It's really interesting time for institutional money to come into this space. The another trend is what I was talking to Fred earlier was like I'm seeing like we talk to these traders who are trying to launch fund emerging managers and what kind of strategy they are doing on the trading side. And interestingly, like everybody is like using AI or machine learning to make more efficiency. It's a good intersection of a blockchain and AI space where they are bringing those into their trading strategies and launching fund accordingly. So those were some interesting area in tokenization. I'm pretty much sure we're gonna discuss more on this topic throughout the webinar today. But the tokenization is something we talk on everyday basis. There's at least a one manager who is wanna to launch a fund in tokenized, whether it's money market funds or asset-backed securities or some of the closed-end strategies like real estate, all the real-world assets. So these are the some of the trends we see as an admin while talking to the emerging managers or the new managers coming to this space.
Okay, great. That's very helpful. Aisha, did you have anything to add to that?
I mean, so we're a fund manager, right? So we are obviously a couple of our investors are like large US fund of funds or like large asset managers. I think it's been very interesting because obviously driven by market volatility, driven by new assets, driven by like all of these treasury sales that are going around, like publicly traded companies stocking up on like crypto products. It's been pretty interesting to see. I think obviously there's a lot of growth, but on the market side, right, like we don't see a lot of like new capital plug in. It's kind of very much like recycled at this point. Obviously we see capital on the ETF side. But the way we talk about like, like large subset of capital coming in, kind of like mainly seen in like structured products. And that's what like Rajat said. untokenized funds or like, ETFs or like, treasuries. But the native market itself is still relatively the same.
Okay, great. Just from my perspective, I'm the tax guy, not, working with the managers at the strategic level, like some of the panel here. One thing that I've noticed is, a lot of companies and even governments mentioning adopting a strategic reserve also with Bitcoin. Do you think that the visibility of that would give more investors confidence in entering the space? Aisha, you mentioned that it's sort of recycled capital. Do you guys think that will, have more people feel comfortable with the asset class?
I think whoever wanted to be comfortable with the asset class, they've gotten enough comfortable to like invest into ETFs and whatnot. Bitcoin as, as the asset itself has done fine. I mean, it's withstanding like a war at this point. So, but the question becomes is like how much of for like our native markets become like integrated, like, on like the larger institutional market, like how many of, Citi guys or like Goldman guys do you see like trading Bitcoin or ETH, right? Like, and if you'd speak to them, they'll say that, look, we're better off trading this like off of CME or, just buying ETFs directly for now. They have their own concerns, which is kind of valid too, like, crypto infrastructure as a whole, given on how like most of these exchanges do exist offshore, and that's where the volumes are. So, I think that's where the entire, the concerns that we see come in. I think all of that is taking its time, as agreed so. But for now, right, like the 3 trillion crypto market cap is kind of like been the same for past few years at this point.
Okay, great. Thank you.
I would add one thing just as it relates to like strategic reserves in particular is that you're seeing companies, it's not just strictly Bitcoin. There's groups that are focused on treasuries around Solana. There's groups that are focused on treasuries around certain other coins. And so I think everyone has their own independent use cases on why or what they would deem a reason for them to be holding a large treasury of a certain digital asset. I think what that does do in particular is, as, Aisha was talking about, as there's a better integration into traditional markets, hopefully these groups see the value of having bearer assets and being able to instantaneously settle in those assets. I think, particularly if you look at private credit markets, if you look at other things that are happening within tokenization, there's a lot of groups who are looking, specifically banks, large institutions, who are looking at not only strategic reserves, but how those tokenization of assets would be intermingling with all of them.
Awesome. That's good intel. Thank you, Pat.
I think I just wanted to add to like one Pat's point too. Speaking of treasury, yesterday we saw an I company buying Hyperliquid. It's like, why is an I company buying Hyperliquid, right? And that brought their stock skyrocketed, what, 135 or 150% by night. So I don't know if it's a good look or a bad look. That's more of a Rajat question that, how he sees swinging. That is, but I personally don't think it's a great look for the industry as a whole, because you cannot use us to build your own leverage. But yeah, like, I mean, and this is just the beginning. Like, this is just June. It started like last month. I mean, let's see how much we can max out that market.
Well, and then the question then becomes, right, is it better to hold and speculate on the holding of those assets, and no investment advice, right? But is it more speculative if these groups are building treasuries to hold on to those assets, or is it better to be trading it actively? So yeah, I think there's a number of different thoughts around that. But. I digress.
Okay, yeah. In the interest of getting through the rest of the content, let's move on to the next slide, please. Okay. So one of the things that I think has been sort of key in the space really since inception is challenges in valuation reporting. A lot of the more commonly traded or liquid assets, stocks, bonds, and so on will have a market. You go to Bloomberg and some of these things, so that's certainly a challenge. I think things have evolved there, but I'd like to start with Rajat. What are the key considerations from your perspective while calculating NAV for digital assets as an administrator, which makes the auditor and tax preparer life easy?
Yeah, no, that's a great question. So first of all, we have to maintain the books in good order, right? In order to have the tax preparer life and auditor's life easy. So some of the key consideration out there is like some of the unique things work in digital assets, which are different than TradeFi. So we have to understand how to make the adjustment in books, right? So one of these, like the classification of income and loss item in the NAV calculation. So when you are taking a transaction from any DeFi or blockchain activities, it's very hard to categorize the transaction into correct or from a US GAAP perspective or from a tax perspective. So as here at NAV, we have built the rule engine to categorize those transactions, but still it takes understanding to how to properly categorize those. So that's very important while going through the NAV calculation in order to do that correctly, so that when auditor or the tax preparer doing their work, it's kind of all flows through correctly. You touched based on the valuation. So valuation is the key to the valuation is to remain consistent over period to follow the same valuation policy on while NAV calculation. Here in digital assets, the source of the pricing is different than the TradeFi world. So there are vendors here who provide independent pricing. Of course, it should be a volume-based averaging pricing, because it's kind of a volume is very key indicator on whether the pricing gonna come correctly. So if you are choosing a source where the volume is not there for particular tokens, you're not going to get the great price for the month-end valuation and for year-end valuation. So that's something you need to be paying attention, which the sources you are picking to the valuation, and remain consistent. Of course, the DeFi side, there's this liquidity pool valuation where you have to get the pricing of the value of your stake in the liquidity pool. There's soft and safe investing where you are depending on managers to do the pricing. So that's kind of valuation area, the income and loss classification. And there are also while a lot of managers move their assets from one exchange to another account, so you as an administrator, you have to do a cost basis transfer of cost basis correctly, not to trigger any realized gain while moving the position one exchange to other. That would create a lot of problem in tax work and audit work. So these are the few key considerations, I think, while calculating NAV or bookkeeping, so that the audit and tax season can be much easier than there.
Okay, great. I think, Hamza, you could probably share from your perspective, as somebody auditing some of these funds, some key things that an administrator could do that would make the audit process easier from a making sure we have a good valuation and reporting perspective. Do you have just any tips or keys or things that a fund manager should be looking for from their administrator?
Yes, thank you, Alex. Before jumping to the key audit challenges in digital assets and funds, I would like to describe why there is a need for audit. You know that there is as per the reports, researches that DeFi is going to be very voluminous, might be triple by 2026. But how it's going to happen? I believe through decentralized financial products, right? And it is increasing. It has increased its demand through institutional investors. And as we have seen yesterday, that there was the House of Senate passed a Genius Act, and with the new administration in White House, they are going to emphasize on this industry, and they are going to rely on this for the years to come, right, and for the decades too, right. And after by seeing this demand, I believe the fund managers are structuring their existing portfolios towards hedge funds, private equity, and all the other and their assets towards these structures, right. So if a fund has created for this specific purpose, right, and they have to report back to their investors and their partners, so there comes a need for the audit as well. And as it is a new industry, and so there are many challenges in while doing an audit of a digital asset fund. So from my perspective, I see that there are four major issues that we have to deal while doing an audit of a digital asset fund. First is their valuation issues. Second one is the custody and ownership of wallets and their exchange accounts. Third one is DeFi complexity, and fourth one is regulatory uncertainty. Right. So let's start with the first one, valuation issues. Right now, as of 25, we don't have any uniform standard like GAAP for crypto. Right. Right now, we have a digital asset guide by the AACPA, which is very helpful, uh, but we don't have a specific standard for it. Second, these assets are very highly volatile in nature, and somehow, to some extent, they are illiquid as well. Right. Second, third point is that fair value estimation. It is always on judgment based. If we compare digital assets with the traditional securities and other market instruments, we can get a valuation based on market income or cost approaches, right? But at this point with digital assets, we are not very certain which market adoption practice is, which fair value estimation judgment is much suitable to this to this niche. So after that, we have custody and ownership issues at the moment. Uh, being how we can verify the ownership and the custody of the digital assets, and specifically the wallets, right? So what we do is that for exchanges, um, uh, the recent let me connect with the first slide, that the managers are now approaching to this niche. Why? Because right now we are going to have a rule, and we are going to have these acts. So with the ownership and with the custody thing, I believe 3 years ago there was a debacle with the FTX, and people lost their money, and this was a, a lot of huge scandal. So after that, I believe Binance, if we look at the Binance, the exchange, they are much pretty well transparent at the moment, and they are doing their regular audits. So if we are auditing the exchange side of investment, we can go through the sort of external confirmation directly with the exchange, and for wallets we can go for the uh, verification of the wallets through a trace of transactions and other procedures. Then we can have a DeFi complexity, uh, right? In DeFi complexity, we we face problem uh, in verifying the smart contracts, like what sort of it is. It's a lending, yield farming, or is it staking? So it's very technical to bifurcate all these kind of contracts, right? And you know that ERC20 ERC20 standard fosters interoperability, but makes auditing more technical. And finally, it's a regulatory uncertainty, as we have discussed before, that we have only one AACPA guideline at the moment to value the digital assets and how to report these digital assets. And the good news is that from the tax perspective is we are going to see 1099 specifically for digital assets, I believe, from this year, and this can be a very great initiative for tax practitioner and for the IRS, that the user is getting their separate information, separate 1099 for digital asset activities. So I believe this is how it's evolving, and with the passage of time, we will learn more, and we can after inclusion of a gap uh, uh, relevant to the uh, cryptocurrency audits, it would be much more easier to conduct the audits. At the moment, it is a bit difficult, but it's still doable. A lot of firms are doing that, and this is still evolving. And if I connect with the Pat point of view, I believe the most popular structure in this domain is mini master structure, and which is prevalent at this moment of time. And for lastly, fair value hierarchy. This is the most commonly asked question among the people, that how these coins and cryptocurrencies should be valued in the fair value hierarchy. Either it should be level 1, level 2, or level 3. So we believe that it's a very simple and clear check. If it's a stable coin which is pegged to USDC, then it's level 1, and the remaining coins which are altcoins, then it should be classified as level 2. For example, Bitcoin and Ethereum, they should be classified as level 2.
Okay, thank you, Hamza.
Yeah.
Before we move on to the next slide, did the rest of the panel have any just parting thoughts on just the current status of the industry and challenges in valuation reporting?
I mean, I know this all was circling back to cutting NAV. And so, being able to cut NAV, and I am surprised we didn't bring this one up. We operate in a 24/7 market. And so that means that the markets don't close and the funds have to define pricing cutoff. And so usually that's a UTC standard. We did that back in like 2015 around, hey, midnight UTC, you got to cut off your pricing. This is where you're going to be defining when you're going to cut NAV. I think the other things that Rajat Hamza brought up around the token complexity, whether they're wrapped assets, rebasing tokens, synthetic assets, I mean, there's all these different complications, especially when you start dealing with other wallet providers, custodians, et cetera. And I think the thing that comes up in particular that, when you have to cut NAV is really understanding your portfolio and being able to reconcile that in a timely manner. And I think that's one thing in particular that we've focused on from an auto perspective is, hey, those cost basis transfers from wallets to wallets, from all those different things, those are already automatically being captured within auto. But the other things that we think about is just around, hey, okay, well, if I've got certain DeFi applications or things that are happening within certain environments, am I actually looking to Hamza's component? Am I actually looking into the smart contract to actually understand what is the type of accounting activity that's happening? Are we tagging that activity appropriately? Is it being bucketed right? So all these things are happening from the actual portfolio side, which, being able to see that, automate the reconciliation, but also be able to understand when you have exceptions and being able to handle that. Those are extremely important things. But I'm also curious to know, Aisha, when you get to the end to cut NAV, is there anything like from your side that you think about in particular?
The thing about Rajat and his team. That's what I do. So they're also our fun admin, right? So I mean, it's a process because we trade a lot of options, and we accumulate a lot of like DeFi yield and all. So and that's when the back and forth between their team and our team begins. They do honor the UTC midnight part, like the market standard. Um, but on the investor reporting, for instance, right? Like sometimes we provide that as an estimate, and these guys say, "Hey, look, it didn't really clear up." So, and we do our best, they do their best, and sometimes we meet in the middle. But it's a process, right? And then I feel like, to their credit, to NF Consulting's credit, they're great at it. But given that it's a market that's, our cutoff is not Friday night, right? Friday night, 2 p.m. Our cutoff is Sunday night, midnight. So it's a consistent, ongoing process that whoever tried automating it, or whoever tried, like, handing it over, to AI agents, or whatever you would want to call it, for the most part, it's very much a manual process for both the fund and the fund admin.
Yeah, meaning that's correct. But because that's kind of we try to make it as automated as, but this transaction flow is good to understand by the team who is experienced, so that it can be properly booked. So it's kind of a mixed process. You're right there.
All right.
Alex,
Let's please, let's move to the next slide to keep on track here. This is just more content, so next slide, please, Sanad. And another polling question. Okay, so Pat, I think you touched on this earlier, that the rise of the stable coins and tokenized assets is certainly a trend that we're seeing. One thing, just from my perspective, I'm not as intimate with the details of the underlying components of all these assets, but my perception is with the stablecoin, they're generally backed by a treasury or some sort of bond or note that is how you reference to the dollar, and you earn a yield that way. I guess my question for the panel is, one, is that true? Are they generally is the market generally backed by U.S. Treasuries, or are there other assets there? And then, if so, if this migration into stable coins continues, is that likely to have an impact on those Treasury markets? Does anybody have any perspective on that?
I'm happy to jump into it and just kind of talk about my experience with stablecoins and where kind of things are going. So back in the day, and just to kind of clarify, the mint burn process as it relates to stablecoins is really just, think about dollars sitting in a bank or a custodian. You have an API that you're pulling data there, and then you're also querying a node, pick whatever network, and effectively you're just monitoring the mint burn on the node. So dollars should equal the tokens that have been created. And so stablecoins effectively, I used to do, we built an attestation product around real-time stablecoin attestations. And we did it with Trust Token, and then we sent it on to a Chainlink Oracle where we could share it with DeFi people. So to your point, like where things are going with stablecoins in particular is stablecoins effectively are about like 95% of DeFi. We'll pick whichever chain or whichever platform or wherever those may be happening, but the majority of people are looking effectively for yield and or depositing tokens and or mixed token bags into certain liquidity pools. And I think the thing that happens with that is that stablecoins not only give people access who are unbanked around the world, who don't have physical location banks, but they have smartphones, the access to the US dollar, which currently is kind of a global reserve that may change here in the future. but it also creates an impetus for others to effectively use that from a payments perspective, so they're not paying a lot of fees on it. But then also for capital markets component, and I'd love to hear Rajat or Aisha related to this one, is just that also brings in new dollars into the system. It's a way of onboarding dollars into the system, so as other assets trade, those trading pairs can be a multitude of different type of stablecoin types, and a lot of LPs and or managers invest into one of these groups. A lot of times, though, they're subscribing the stable coins. And so, yeah, I think it's great for treasury markets. It's great for the proliferation of the dollar. But there's also a lot of other use cases, depending on who and how they're interacting with it.
Makes sense. From a Pat, one thing you said resonated with me, that a lot of the uses, anybody with a smartphone that may be debanked are flocking to these markets. Is there a similar interest in the fund space for expanding their exposure to stablecoins?
I think that all comes down to yield, right, Aisha? Like, most of them are utilizing stablecoins for yield. Am I correct?
In payment rails? So, I mean, our entire ecosystem is like built on stable coins, right? Like, we don't, the trading volume is literally just Tether USDC, or like, what was it? The other one? God, I'm forgetting the name. Athena. And Athena for DeFi. And so trading volumes, like, aside from like yield, which is also somewhat stable, subsidized, the entire ecosystem is built on stablecoins for now.
Okay, great. What about the role of tokenized assets? The expansion of that market.
I think that it's great. I think liquidity is a concern there. I don't know if these guys disagree or agree with me, but I think it's a great new way to like raise capital from like individuals, or like other investors that have been trying to dip their feet into crypto, haven't done it yet. But question remains is like, where's the liquidity coming from, right? And I don't know if like native funds like us would dip their toes yet. But whoever is doing the offering, whether it's through Securitize or like Republic, it literally basically boils down to is where they're raising their external capital from. I think the BlackRock tokenized assets would technically do well because they're the ones providing liquidity. Hamilton Lane has somewhat did okay, but that's always been the concern. And then once these assets have been tokenized, where are they being traded? That market really hasn't kind of like taken off in 6 years, 6 to years or so. There needs to be a market for that. But that's my concern with like tokenization.
Yeah, meaning I kind of agree with Isaiah. I talked to the smaller manager who wanna just tokenize the fund in hope for raising capital, and that's kind of I think that's not gonna help them. I see a lot of launch fund but not able to raise capital. Just being done on tokenization wouldn't mean, I guess, to attract capital. It's a easier way to kind of fractionalize, and a lot of illiquid capital, liquid asset class can kind of get liquidation out of it. But what we are seeing most of the time now is the money market funds or asset-backed securities with some, those are the ones which are going in. So after this BlackRock product, I think people are interested to see the way to go about it. But these are every day we are having this conversation. From an administrator point of view, the workflows are different in tokenized fund, of course. Sometimes they want us to act as a transfer agent. Sometimes they want to take the platform, want to take the role of it. Still 50-50, I guess. Some people, because it's not as straightforward if you're launching a BVI fund and you want to do like a AML KYC. The platform are known for their technology for minting and burning, but to build the entire regulatory AML KYC process is something what we have seen they are not able to achieve. So we are still acting as a transfer agent and then publishing NAV back to the platform for the tokenized fund. So it's kind of different workflows in tokenized fund from an administrator point of view. But of course, there's interesting conversation every day.
I would say for anyone who's interested in like what is happening from a tokenization standpoint to just go to rwa.xyz, and effectively they're tracking not only all the stablecoins that are being created, but also what's happening from a private credit perspective, as well as the institutional funds and stocks that are being tokenized as well. To Rajat's point, like each fund would have a reason for why they would want to tokenize. They assume that it would create liquidity. I think there's nuances around just the operations around that. But I think the majority of what you look at, anyone would look at, especially if you look at rwa.xyz, it's just a public analytics dashboard of all things that are tokenized. Effectively, the majority of it is all private credit. So that means it's just basically lending or mortgage-backed securities from Figure. There are some things that, like Maple, and some of them are also like challenging on some of those things. But I think the majority of the use cases, I think right now we are able to actually tokenize these representations of assets, which is great. The question now is going to be, how is that going to accelerate or create additional access or liquidity? I think there's still some narratives to be figured out there.
All right, great. Thank you, Pat. We are running a little short on time, so I'd like to move on to the next slide, please. So as far as DeFi engagement, what are the opportunities for investment firms to capitalize on the growth in these applications? Is there a particular strategy, or is it these are applications that are helping the investment firms manage their operations? Like, what's the play here from a fund perspective? Any thoughts on that?
I'm going to defer to Aisha on that one. She's the manager.
I don't think so. I mean, I think that I think we're a bit far from it. We use it like when we're transacting, which we have a strategy on DeFi. So like obviously we're like integrating with, interacting with these pools quite often. But I think that it just becomes easy when we're sending that transactional list or transaction hash to like NAV, and they're able to pull that off, easier. But to source that data into our PMS and then transfer it to NAV the way NAV can easily do the API keys, it's still not doable. And so that's where the manual entry kicks in. And I mean, it's great, but I think it could be done better, and it will probably be done better over time.
A bit early, in other words.
A bit early, very, very early. I would say about 5 years early. Like unless and until I think Pat is working on it. Pat, like with Auto, is working on it. I think that probably would be the first solution. But for the longest time, fund admins like us would be very much dependent on the manual input.
Yeah.
Maybe to piggyback on that thought, like real quick, like it really is dependent on which ecosystem you're participating in. Like strategies differ depending on the protocol. So like, for instance, let's just say like where is a lot of DeFi activity going nowadays? I say a lot of that is actually going on Solana. And so for anyone who is interacting with Solana knows initially that was like very, very, very complex to sort out a lot of just the data and the transaction nuances happening with that. but like there's groups that you could lend, borrow, yield protocols like Camino Finance, and there's DEX aggregators like Jupiter. There's also like they do perpetual futures and spot trading on Drift. I think it really, you have to look at, okay, well, if I'm also going to be doing yield, like, do I just participate on Jito and then get some Jito on top of that and try to create some sort of MEV optimized liquid staking strategy? I think there's a number of things you could do. It just really is dependent on the ecosystem.
Okay, great. That's very helpful. Let's continue on to the next slide so we can try to get through all this content. Again, next slide, please. One more polling question. Okay, just to make sure we get to the last slide, which is strategic recommendations, I'll just ask this, one question to the panel. So how are your respective firms or other firms that you work with gaining training in this area? Is it safe to say that it's early enough that this is mostly on-the-job experience, or are there resources out there available that people that want to expand their knowledge could utilize or go to? Anybody have any thoughts? Jack, what do you think?
Meaning I can pick it up. Meaning for our team, we have been involved in digital assets for over 8 years now. When we first began, we had no idea how to do the administration for digital assets fund or in general. So it's on the job training first, and all of the material out there, you go to the conferences, meet people. There is like an ecosystem of the service provider where you could ask. So all of the general material is out there, but if you run into a specific use case, you have to kind of go to lawyers, to audit firms, to tax preparer to kind of come together and come up with the solution of that particular situation. And it's kind of, there's no lack of regulatory guidelines here, so there is always best practices come into the play and follow it consistently. So there are material out there, I would say, but that may not necessarily solve your use case, a particular situation when you are actually doing the work for different situations.
Okay, great. And then Pat, I'll ask you your thoughts.
Yeah. So in a lot of ways, MG Stover became a farm system for CFOs in crypto. Effectively, what would happen is that we had worked with a number of crypto fund managers. They liked our team members, and they ended up hiring a lot of our folks. So I think the thing that came up in particular really was it's a process. Crypto is not effectively taught at school, especially around accounting treatments, et cetera. Even around investment fund nuances, it's a technical nuance. And also keeping up with the technology component can be pretty difficult. And so what we've done for ourselves is that it does require a significant amount of training. But the other expectation is that they're likely going to go to a fund manager who can pay them a whole lot more. And I think the thing that comes up for us is really just being able to build tools that make folks' lives easier, and really just be a good steward and make sure that if there are new things that are happening, et cetera, that you liaise with other folks within the industry, whether those are CPA firms, lawyers, et cetera, like Rajat had mentioned.
Okay. Yeah, I mean, so, what I'm hearing from both of you is sort of what I experienced and my understanding that it really is on the job training at this point. And, working with a good team and a good firm that's in the space is really the best way to learn. So let's move on. This is the slide I want to give each of the panelists an opportunity for strategic recommendations for 25. So we are running out of time, so we could just kind of keep this to like 30 seconds for each. If you just had one recommendation from your perspective for a successful 2025, what would it be? Rajat, I'm going to go left to right on my screen. So Rajat, you're on my left.
Sure, no problem. Yeah, I think the institutional adaptation is the most important. When more and more institutional gonna bring the money, it's gonna make this space further and further. So I think making sure that the controls, the internal controls, and are there for them to welcome in this space is what I'm looking for.
Okay, Pat.
I would say I think the data and new financial products are going to become more important as institutions come in. They're going to want more reliable data, standardized data that can feed into the reporting systems. I think that is going to help everyone be able to grow with the regulatory clarity.
Okay, Aisha, what do you think?
I think we're in a very interesting time frame, and it's been fun. And I think we're growing like any other asset class. And yeah, we're excited to see what the future brings.
Okay. And Hamza, could you bring it home from your perspective? 30 seconds. What's your key for a successful 2025 for anybody in this space?
From the reporting and auditing perspective, I believe the firms, the CP firms, needs to take this industry as a strategic industry rather than an optional. And the clients and the institutional investors and all the uh, concerned partners will be looking for more in-depth, detailed knowledge regarding the auditing and the financial statements. And and we are expecting that a full-fledged US GAAP comes in place for compliance and regulatory other stuff. So hoping that just like 1099 DA, it comes early so that we can service the clients best. I believe so.
Okay, thank you. We're down to our last quick poll. So while everybody's looking at this, I would just like to thank the panel. Really good content. I know I learned a lot. For anybody that is in the space that's not interacting with the people in this panel, you should be. And thank you again. Any parting thoughts?
Thank you for having me.
Thank you, Alex.
All right.
Thanks
Thank you,
for
guys.
having us.
All right. You all have
Thank
a
you.
good afternoon.
Bye.
Bye.
Bye, Hamza.